In this video, we are going to break down 3 powerful stocks that could surge during one of the most important geopolitical flashpoints in the world right now, the Strait of Hormuz oil crisis. The Strait of Hormuz is one of the most critical choke points in the global economy. Roughly 1/5 of the world's oil supply flows through that narrow passage every single day. When tensions rise in that region, energy markets react instantly, prices spike, supply chains tighten, volatility increases, and here is the key insight most investors miss. When energy prices rise sharply due to geopolitical risk, it does not just impact oil companies, it ripples across agriculture, transportation, industrial production, and even food security. That means the winners are not just oil producers. The winners are the companies that sit upstream and downstream of that entire system. What you are about to see are not random picks but dominant businesses sitting at the center of global energy, food supply, and commodity flows, with the kind of scale and strategic positioning that can turn global disruption into long-term opportunity. And the first company sits right at the heart of U.S. energy production, Devon Energy, ticker symbol DVN. Now before we even talk about numbers, let's talk about why this business matters. Devon Energy is not just another oil company, it is one of the most efficient shale producers in the United States, with a strong position in the Delaware Basin, which is part of the Permian, the most important oil-producing region in North America. Here is why that matters. When global supply is threatened, countries look inward. They prioritize domestic production. The United States becomes even more important as a stable supplier of energy, and companies like Devon are at the front of that shift. This is a business that has built its entire strategy around capital discipline, efficient drilling, and maximizing free cash flow instead of chasing reckless expansion, and that is exactly the kind of company you want during a crisis. Because when oil prices rise, inefficient producers struggle with costs, but efficient operators like Devon expand margins dramatically. This is where things get really interesting. Devon is not just positioned to benefit from higher oil prices, it is structured to return that upside directly to shareholders. The company operates with a variable dividend model. That means when cash flow increases, investors get paid more. So you are not just betting on oil prices, you are getting a direct participation in the upside. And during a geopolitical shock like the Hormuz situation, that matters. Because you are not waiting years for growth. The impact shows up almost immediately in cash generation. Now let's talk about the financial side. Devon has consistently focused on maintaining a strong balance sheet while generating significant free cash flow. The company has reduced debt over time, improved operational efficiency, and kept its break-even costs relatively low compared to peers. That means even if oil prices fluctuate, Devon remains profitable. But when prices spike, profitability expands rapidly. And here is another key point from the article that many investors overlook. The current geopolitical environment creates a supply risk premium in oil markets. That means prices are not just driven by demand, they are driven by fear of disruption, and companies like Devon benefit from both. Higher realized prices and strong operational leverage. Let me give you a simple way to think about this. If oil moves from $60 to $80 or $90 due to geopolitical tension, Devon's revenue does not just increase linearly, its profits expand disproportionately because many of its costs are already fixed. That is the power of operating leverage, and that is exactly what you want exposure to in a crisis. But there is a second layer to this story that makes Devon even more compelling. The company has been extremely disciplined about capital allocation. Instead of overspending on production growth, it has prioritized shareholder returns and efficiency. This reduces risk, because in past cycles, energy companies destroyed value by overexpanding during high-price environments. Devon is doing the opposite. It is focusing on sustainable returns, which means it is better positioned for long-term compounding. And this is where smart investors pay attention. Because the goal is not just to benefit from a short-term spike. The goal is to own businesses that can turn volatility into long-term wealth. Now think about this. Global energy demand is not going away. In fact, with AI data centers, electrification, and industrial growth, energy demand is increasing. At the same time, supply is becoming more constrained due to underinvestment and geopolitical risks. That imbalance creates a powerful setup, and Devon sits right in the middle of it. So when you combine efficient operations, strong cash flow, shareholder returns, and exposure to rising oil prices, you start to see why this stock stands out. If you're getting value from this video, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second company, Equinor, ticker symbol EQNR. Now here is the key question: why would a Norwegian energy company matter in a Middle Eastern crisis? Because when supply from one region becomes uncertain, global buyers look for alternative suppliers, and Equinor is one of the most important energy providers in Europe. That gives it strategic importance. Europe has already gone through an energy shock in recent years. It has been forced to diversify away from unstable supply sources, and Equinor has become a critical part of that transition. Here is the retention hook. This is not just about oil, this is about energy security. And energy security is becoming one of the most valuable assets in the world. Equinor operates across oil, natural gas, and renewables, but its natural gas business is especially important. Because during geopolitical tension, natural gas demand in Europe tends to increase as countries seek reliable supply. And Equinor is one of the largest suppliers of natural gas to Europe. That creates pricing power, and it creates long-term contracts that generate stable cash flows. Now let's talk about what makes this business different. Equinor is not just an energy producer. It is a state-backed company with deep strategic alignment with European energy policy. That gives it advantages that private companies do not have. Access to projects, regulatory support, and long-term demand visibility. And in times of crisis, those advantages become even more valuable because governments prioritize stability, and they work closely with companies that can deliver it. Now let's break down the financial side. Equinor has strong cash flow generation driven by its diversified portfolio. It benefits from both oil prices and natural gas pricing, which gives it a more balanced revenue stream. That reduces volatility compared to pure oil producers. But here is where things get interesting. During periods of geopolitical tension, natural gas prices can spike even more dramatically than oil, and Equinor is directly exposed to that upside. So you have a company that benefits from multiple angles: oil price strength, natural gas demand, and strategic positioning in Europe. That is a powerful combination. Now here is another retention hook, but the story does not stop there. Equinor is also investing heavily in the energy transition. That includes offshore wind and low-carbon projects. Now you might be thinking, why does that matter in an oil crisis? Because it gives the company long-term relevance. This is not a business that is dependent on a single commodity. It is evolving with the global energy landscape. And that means it can continue to grow even as the world shifts toward cleaner energy. So you are not just buying a short-term geopolitical play, you are investing in a company with a long runway. Now let's connect this back to the Hormuz situation. If tensions disrupt oil flows in the Middle East, global buyers will scramble for alternative supply. Europe will prioritize stable partners, and Equinor becomes even more important. That can lead to higher prices, stronger demand, and increased geopolitical leverage. And for investors, that translates into potential upside. So when you step back and look at the full picture, Equinor offers something unique: exposure to global energy markets, strong positioning in Europe, diversified revenue streams, and long-term transition potential. And that combination is rare. Now think about this for a second. Most investors focus on U.S. energy companies when oil prices rise. But global diversification matters, because the energy market is interconnected, and sometimes the biggest opportunities come from companies that are positioned outside the obvious narrative. Equinor is one of those companies, and in a world where energy security is becoming a top priority, its role is only becoming more important. Now let's move to the third company, and this is where the story takes a completely different turn. Mosaic, ticker symbol MOS. Now before we talk about numbers, let's talk about why this business matters. Mosaic is one of the largest producers of phosphate and potash fertilizers in the world. At first glance, that might not seem connected to an oil crisis, but here is the key insight. Energy and agriculture are deeply connected. When oil and natural gas prices rise, fertilizer production costs increase, transportation costs increase, and ultimately, food prices increase. And that creates a powerful ripple effect, because farmers still need to grow crops. Global food demand does not slow down just because energy prices go up. In fact, it becomes even more critical. And that is where Mosaic comes in. This is a company that sits at the center of global food production. It provides essential nutrients that farmers need to maintain yields. Without fertilizers, crop production drops significantly. So regardless of what is happening in the oil market, demand for Mosaic's products remains strong. Now here is the retention hook. This is where things get really interesting. When energy prices spike, fertilizer supply can become constrained. Some producers reduce output because costs become too high, others face logistical challenges. But demand does not disappear. That imbalance can drive fertilizer prices higher, and when prices rise, companies like 𝗣𝗟𝗡𝗧 benefit significantly. Because they already have the infrastructure, the production capacity, and the global distribution network in place. So just like Devon benefits from higher oil prices, 𝗣𝗟𝗡𝗧 benefits from the second-order effects of those price increases. Now let's talk about the business itself. 𝗣𝗟𝗡𝗧 has a strong position in both phosphate and potash markets. These are not easily replaceable products. They are essential inputs for agriculture. And that gives the company pricing power, because farmers cannot simply stop using fertilizers. They may adjust usage slightly, but the underlying demand remains. That creates a resilient business model. Now here is another retention hook. But there is a deeper layer to this story that most investors miss. Global fertilizer supply is concentrated. A significant portion of production comes from a few key regions, and those regions are often exposed to geopolitical risk. So, when disruptions happen anywhere in the global supply chain, prices can move quickly, and 𝗣𝗟𝗡𝗧, with its scale and geographic diversification, is positioned to capture that upside. Now let's bring this back to the Hormuz situation. If energy flows are disrupted, oil and gas prices rise. That increases costs across the agricultural supply chain. At the same time, transportation bottlenecks can impact fertilizer distribution, and that combination creates tight supply conditions, which pushes prices higher, and higher prices translate into stronger margins for producers like 𝗣𝗟𝗡𝗧. Now let's talk about financial context. 𝗣𝗟𝗡𝗧 has historically generated strong cash flow during periods of elevated fertilizer prices. The company has also focused on maintaining operational efficiency and managing costs. That is critical in a cyclical industry, because when prices rise, efficient producers capture the most value, and 𝗣𝗟𝗡𝗧 has demonstrated that capability over time. Now here is another key point. The company has been returning capital to shareholders through dividends and share buybacks. That means investors are not just relying on price appreciation, they are also receiving direct returns. And in a volatile market, that matters, because it provides an additional layer of stability. Now here is the retention hook, but here is the part that really ties everything together. Energy, agriculture, and geopolitics are all connected, and 𝗣𝗟𝗡𝗧 sits at the intersection of those forces. So while most investors are focused on oil producers during a crisis, the smart money is looking at the second and third order effects, because that is where inefficiencies exist, and where opportunities are often mispriced. Now think about this. If oil prices rise sharply, everyone rushes into energy stocks, but fewer investors look at what happens to fertilizer prices. Fewer investors think about how rising input costs impact global food production, and that creates a gap, and that gap is where 𝗣𝗟𝗡𝗧 operates. Now let's zoom out for a second. What we have just covered are 3 different ways to play the same macro theme. Devon Energy gives you direct exposure to rising oil prices. Equinor gives you global diversification and exposure to both oil and natural gas with strong geopolitical positioning, and 𝗣𝗟𝗡𝗧 gives you exposure to the downstream effects on agriculture and food production. 3 different angles. 1 connected thesis. Now here is the retention hook. And this is the part that separates average investors from great ones. Great investors do not just follow headlines. They follow money flows. They understand how one event creates ripple effects across multiple industries, and they position themselves ahead of that movement. That is exactly what we are doing here. Now let's bring everything together and talk about the bigger picture. Because this is not just about a short-term trade. This is about understanding how global systems work. When geopolitical tensions rise, markets react quickly, but the real opportunity comes from understanding the second and third order effects. Energy prices impact transportation. Transportation impacts agriculture. Agriculture impacts food prices. And each step creates new opportunities. Now here is another important point. These companies are not speculative plays. They are established businesses with real assets, real cash flow, and long-term relevance. That reduces risk. Because you are not betting on hype. You are investing in fundamentals. And in uncertain times, fundamentals matter more than ever. Now let's shift into the final section, because I want to leave you with a framework you can use beyond this video, something that helps you think like an investor, not just a trader. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now here is the question I want you to think about. Out of these three businesses, which one do you believe has the strongest long-term advantage in a world shaped by energy insecurity, and why? Is it the direct leverage of an efficient oil producer like Devon Energy, the geopolitical positioning and diversification of Equinor, or the essential role of Mosaic in global food production? Let me know your thoughts in the comments, because the best insights often come from discussion. Now let's wrap this up. In times of uncertainty, most people panic, but great investors prepare. They look beyond the headlines, they understand how global events create opportunities, and they position themselves accordingly. So instead of reacting to the next crisis, start thinking about how you can benefit from it, because the market always rewards those who think ahead. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.